Hello everyone and welcome to a new episode. I hope you all enjoyed the previous session. For those who are seeing me for the first time, welcome to my channel Studios. This is a place where you will find simple, clear and friendly explanation of accounting information system. It is a system a business uses to collect, store, process and report all its financial information. You can think of it as the brain of the accounting function. It gathers every financial activity like sales, purchase, payments, receipts and salaries and organizes them in a structured way. Once the data is collected, the system processes it into useful reports such as ledgers, trail balance, financial statements, and analysis reports. These reports help managers, accountants, and decision makers to understand what is happening in the business and plan for the future. A modern AAS usually uses computer software to make work faster, more accurate, and more secure. Overall, AAS ensures that the financial information flows smoothly from the moment a transaction happens until it becomes meaningful information for decision making. Components of AAS. AAS is built from several connected parts that work together to handle financial information. It starts with the people who operate the system, accountants, managers, data entry staff, and anyone who uses or inputs the financial data. Then comes the procedures and instructions, which guide how transactions should be recorded and processed and reported. The system also relies on data, which includes all the financial information related to sales, purchase, expense, assets, and liabilities. Technology plays a more important role through the hardware like computers and servers, and the software that performs accounting tasks. Finally, internal control ensures the system is safe, reliable, and protected from errors or fraud. When all these components work together, the AAS become an organized and secure system for managing financial information. Functions of AAS. The main function of an AAS is to capture every financial transaction that occurs in the business. Once the data is collected, the system processes it through classification, recording, summarizing, so that the raw data turns into a meaningful financial information. It then stores this information securely so it can be accessed whenever needed. The AAS is finally produces reports such as financial statements, budgets, and analysis reports that help management and external users understand the business financial health. Also, with all these, the AAS ensures accuracy, supporting decision making, maintains a smooth flow of financial information across all departments. Benefits of an AAS. An AAS brings many advantages to business. It increases accuracy by reducing human errors and ensures that financial data is recorded and processed consistently. By automating routine tasks, it saves time and accounting work faster and more efficient. The system improves decision making because it provides updated and clear financial information whenever needed. It also enhances security through internal control that protect the business from fraud, data loss, and unauthorized access. Additionally, an AAS helps business comply with the legal and tax requirements by maintaining proper records and generating reliable reports. Overall, the biggest benefit of the AAS turns complex financial data into easy to use information that supports better planning and smoother business operations. Qualitative characteristics of accounting information. Relevance. Information that influences users' decisions with predictive or confirmatory value. Reliability. Free from material error and bias, verifiable, faithful and neutral. Comparability. Allow users to identify similarities and differences across companies or periods. Understandability. Presented in a clear and concise manner for users' comprehensions. Timeliness. Available to users in time to influence their decisions. Accounting equation and common accounting terms. Accounting equation. Asset is equal to liability plus capital. Asset. Assets are the resources owned by a business that have value and can generate future benefits. They include items like cash, building, equipment, and inventory. Liabilities. Liabilities are the amounts a business owes to others. They represent future obligations such as loans, bills payables, and outstanding expenses. Owner's equity. Owner's equity is the owner's financial interest in the business after all the liabilities are deducted from assets. It shows how much of the business actually belongs to the owner. Revenue and expenses. Revenue is the income a business earns from its operations, like sale of goods or services. Expenses are the cost incurred to earn that revenue, such as salaries, rent, and utilities. Debtors and creditors. Debtors are people or business who owes money to the company because they bought goods or services on credit. Creditors are those To whom the company owes money for purchase made on credit. Purchase and sales. Purchase refers to buying goods or services for the business use or resale. Sales refers to selling goods or services to customers and earning income. Stock or inventory. Stock or inventory represent the goods a business keeps for sale or use in production. It is a current asset that helps the business in generating revenue. Debit and credit rules, also called golden rule of accounting. Understanding the three types of accounts and the debit and credit rule is fundamental to accounting. First one, real account. A real account deals with assets, things the business owns, like cash, furniture, building, and machinery. These accounts carry their balance forward to the next year. Rule, debit what comes in, credit what goes out. Personal account. A personal account related to the people, organizations such as customers, suppliers, and the owners. It records transactions with the individuals, firms, and companies. Rule, debit the receiver, credit the giver. Last one, nominal account. A nominal account deals with the income, expense, gain, and losses of the business. These accounts close at the end of each financial year and helps calculating profit or loss. Rule, debit all expenses and loss, credit all incomes and gains. Thank you for watching. I hope you found this session helpful and easy to understand. Keep learning and stay connected for more short videos and practical lessons in accounting. Don't forget to like, share, and subscribe Studioso, your space for clear and simple accounting concepts. See you in the next video.